I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show.
Nice to be on your show, Jim.
Well, the U.S. Fed has hiked its rate, as you said, for just the second time in 14 years. That makes it a pretty rare event, doesn't it?
Yeah, and the last time they did it was actually last year. So they went, I guess, 13 years with nothing, and now a year ago they did a small hike, and today they did another small hike. Now some people, like Larry Summers, the former senior Treasury official and also chairman of Harvard University and well-known economist, said that they might have made a mistake hiking rates, but that's a minority view. I think most people feel that the Fed should have moved sooner, if only to regain their credibility. But the bigger news today, I think, was the fact that they talked about, without mentioning Donald Trump at all, they hinted at the fact that they might have to raise rates faster if Donald Trump carries through on some of his campaign promises. Then that's obviously a big if. We don't know if he will, but the Federal Reserve is sort of pointing to itself or positioning itself to be the sober advisor in terms of trying to rein things in a little bit. So, for instance, if there was a huge fiscal stimulus put in by the government, if Donald Trump could get Congress to agree to that, then the Federal Reserve might hike interest rates even faster. And that's probably why the market went down today, is because I don't think most people had actually thought of that angle to it, which is a fairly big angle. But, the employment rate, we're almost down to 4.5% employment, something like that, unemployment, I mean, and I don't know where the maximum is, but it's got to be somewhere around that level. There isn't a whole lot of room left to push the unemployment rate any lower. So then the next thing would be inflation, and that's where the Federal Reserve would get really concerned.
What about Canada's position in all of this?
Well, we tend to be followers rather than leaders, obviously, and we in Canada, for instance, one of the shocking things in the last couple of months is how quickly rates have risen in Canada. So the 5-year rate, the last time I checked, and it's been a while, like a few hours since I checked, so it might have changed. The 5-year rate in Canada had gone from 50 basis points to 1.25 basis points, and the 10-year rate had gone from 1% to 1.75%. So those are huge increases. That's going to have an impact on mortgages and consumer loans, that sort of thing. The cost of funding for the banks is going to go up, and that's going to be a factor. So all of that happened before the Federal Reserve increased their rates. So if the U.S. is increasing their rates, if inflation is picking up in the U.S., I guess Canada could run an independent path and try to keep our rates lower, but what that would mean is that money would leave Canada and move to the U.S. where they get a higher interest rate on their deposits, and our dollar would drop dramatically, which then, of course, would mean that would create a whole new set of problems for Canada that we probably don't need to put ourselves in that position.
Well, Stephen Polo's already did that, dropping the Canadian loonie before the crisis in the oil patch, and other people have told me that was no favor, especially to low-income Canadians who have to import their food in the winter.
Yeah, I mean, like you think about and the amount of stuff that Canada imports and exports, the inflation rate really matters a lot to Canada. We buy we don't produce a whole lot of stuff in Canada anymore. We produce a few cars, I guess, and we do produce oil, which we sell, but we produce lumber, which we sell, but but most of the consumer goods that we buy are brought in, and also a lot of the food that we buy is brought in. So the inflation rate for the average person would go up pretty dramatically if our dollar dropped back into the 60s again and stayed there for a while. So the Bank of Canada and Stephen Poloz are going to really be in a hard place in terms of whatever decision they made. They would have a real problem. The difficulties that are looming because of what the U.S. is doing are pretty large, and I think it's just a path that we have to get through. It seems like to me, although today's decision by the Federal Reserve was kind of portrayed as, well, everybody expected it, and it's no big deal. It seems like it might mark a turning point on top of what's happened in the last couple of months with rates going so much higher. So, like even today, the 10-year rate in the U.S. we jumped from 2.45 to 2.58, and in Canada that 1.75 rate I mentioned is up to 1.79. So our rates are still in Canada quite a bit lower than they are in the U.S., but we're probably going to have to play catch up at some point.
Are the interest rates being paid to people with savings accounts going up as well?
Well, it's interesting you mentioned that, because one of the things that I was listening to some of the commentary and reading some of the stuff, and one of the reasons you and your listeners have probably noticed the banks have rallied quite a bit, especially in the U.S., but in Canada too. And one of the themes that's going around is this is a positive for the banks because they're going to be able to make more money because the spread's going to widen. Well, not necessarily, because if they find it hard to borrow money in order to fund their deposits, their loans, they may have to pay more for their deposits if people decide to move their money around. And I think people are pretty tired of these non-existent interest rates on deposits, so they may demand that the banks raise the return on deposits, and then the spread doesn't necessarily widen. And of course, the other thing, which is probably maybe more of a problem in Canada with higher rates, is can the people afford to pay any more interest on their debts? I mean, the debt levels we've talked about, you and I've talked about before, how dramatically higher the debt levels are than 10 or 15 years ago in Canada. And those mortgages and those loans, they tend to eventually the interest rate adjusts to the new higher rates. So when people start paying more money on interest, they may not borrow as much money from the bank, so it could be a negative for the bank in terms of how many loans they can put out and the size of the loans they can put out. I mean, already with the changes in CMHC, the average size of a housing loan is probably going to be smaller, and that's a negative for the profits of the banks. So I don't see it. I'm a little surprised. I plan to do some more research. Maybe the next time we talk, I can have some more specific numbers ready. But my initial impression is I'm a little skeptical about this general belief that higher rates is an automatic win for the banks. Hopefully the savers might get a chance to win for the first time in a long time, which basically means the bank doesn't win as much if rates go higher.
Well, I know insurance companies and pension accounts are looking forward to higher interest rates.
It's an unequivocal win for them. So the way the insurance business works, of course, let's say the pension plan is a little bit easier to understand. Is they owe X dollars 25 years from now when somebody retires, and if interest rates are only 1%, then they have to set aside a lot of money to get ready to pay that pension. But if interest rates are 5%, they have to set aside a much smaller amount of money, and that's going to be a big win for the pension plans. And the insurance works similarly. So I don't see the banks necessarily cashing in on higher interest rates. It might even be a negative for some of them or a positive, but kind of a mixed bag. But for the insurance and the pension plans, it's an unequivocal win, which is good because the Ontario pensions, I know they put out their numbers a couple of years ago when I was looking at them, and they were getting 75% of their funding for somebody's retirement in the Ontario Teachers Pension Plan from market returns. Well, if market returns are going to be 1 or 2%, they can't possibly count on that. So they would have to ask the teachers and or the government to put in more money, and that's going to be a huge problem for the economy, not just for the pension plan, but for the economy. So in other words, imagine the teacher that's got a big loan on her house, and she's got to put more money into her pension, she's just going to have less money to spend on that new car or whatever it is that she was hoping to save up for.
We'll have more with Hilliard MacBeth right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, with higher interest rates, of course, higher mortgage rates, in the greater Vancouver area, we're seeing housing prices fall. We've seen some estimates, 25-30%. At what point, though, do people start dropping their house prices, even though, they're keeping them on the market now longer, hoping to get that price that was being offered 6 months ago? How is there a certain magical formula that tells you, okay, I give up, I'll just sell it for whatever I can get?
Well, great question. And so there's basically different people that are in that position. So there's the people who you alluded to there in your question that are looking for that particular price. Maybe it's the high water mark that they saw a neighbor get, and they know that their house is worth more than that neighbor's house. So they're not going to budge from that price. If they don't sell it, they are more likely to pull the house off the market and just say, you know what, we'll just stay put where we are and we won't do anything. But then there's other people, and I would say a lot of the speculators in Vancouver might be in the second category, that they're actually kind of counting on the big gain on the house because they borrowed a lot of money, or maybe they're speculators who have bought the house and then fixed it up and put it up for sale as a flip or something like that. And if there's a lender involved, and there usually is a lender involved, then they would be under the gun, and they wouldn't have a choice. And those would be the ones that drive the price, not the first category. Those people, they're not, if they don't get what the price they want, they're just not going to play. They're going to take their football and go home. But the second people, they don't have that option. The lender eventually would take over if the loan can't be repaid. And a lot of times the lender doesn't care. The lender just says, you know what, just put it on the market, just get rid of it. Just put it on the market. We're a lender. We're not in the business of having a bunch of houses, on our balance sheet. So once that process starts, then that's when you get the whole new price. And sometimes there's a lag. It can't be as long as 3 months, 6 months, 9 months, or even a year before the lenders get involved. But if there are lenders involved, and I suspect there are a lot of lenders involved, some of them are pretty aggressive in terms of wanting to get their loan back, and they don't care. They have the legal right to gain control of that property once that borrower is unable to repay the loan or to make the payments. And so rising interest rates on top of everything else, up until now, with rising house prices and low interest rates, a lot of times speculators that got into trouble with those loans, they were able to refinance, even though they probably couldn't really afford to pay back the loan. As long as they could get a new loan that paid back the previous loan, they would be okay. But with falling prices, and the other thing that happens with falling prices is appraisals get tighter, and people start looking at the whole thing differently, and that they start being more careful. The lenders start getting more cautious. It can become a cascading thing where they end up cutting their prices quite a bit out of necessity. But most people voluntarily, if they have any kind of choice, they generally don't cut their prices. They just say, oh, we'll pull it off the market, we'll wait for our price. They might be waiting 10 years. In the case of Vancouver, they could be waiting a really long time. But in Calgary and Edmonton, the economy is extremely weak. It's a severe recession. Prices have not plummeted yet because a lot of people are just holding out for their price. But they're also not able to make the sale either. So there's kind of a standoff right now.
What does this do to the home equity loan business?
Well, the home equity loan business is really dependent on in my opinion, it's dependent on rising home prices, because I've heard stories, I don't know if they're accurate or not, but I've heard stories about people actually refinancing their homes multiple times a year to pull money out. As long as they can get that appraiser or somebody, maybe just the lender or whatever, to agree that the house is worth another 100,000 or 200,000 than it was last year, they'll pull that money out. And in a lot of cases, this is quite dangerous, but I'm sure it's been happening. They actually use that extra money to buy another house or buy another property. So they're speculating with borrowed money, and that can be very dangerous. So the increase in home equity loans as a percentage has been even more rapid than the increase in mortgage. The mortgage loans have been going up steadily for a decade or longer at a pretty steady clip of 5, 6, 7, 8% a year. But home equity loans were going up even faster than that. But either it needs house prices to rise, or it needs people that were debt-free, like older people, maybe that to decide to get back into the lending, the borrowing business, maybe to help their kids buy a house or something. And there's been a lot of that going on. I hear anecdotally that's a big source. But that's been the fastest growing product in the lending game. It's not as big as mortgage. I mean, mortgages are 1.3 trillion, and home equity loans are about a quarter of that. But that 200 and something billion that the home equity loans are in is come up from almost nothing 15 years ago. It's all brand new, and everybody, they were sold as a way to tap into the equity in your home and do what you want now, and don't worry about it. Your home will always be a good source of money, and so I think that rapid increase, at the very minimum, that rapid increase would end with the leveling off of home prices. And then if home prices actually decline, like you were talking about in Vancouver, then there's going to be trouble with the home equity business, because the mortgage comes first and then the home equity comes second.
What about reverse mortgages? Is that just part of the home equity thing?
I think reverse mortgages are a special case. They have a different legal structure, and I've been meaning to look into them. When clients ask me about them, I suggest if they're mortgage free, I suggest to them that they just get a home equity line of credit rather than a reverse mortgage. And the reason is that you've got way more control with a home equity line of credit. The reverse mortgage, as I understand it, now I haven't done the research on this yet. There's a fixed schedule, and the costs can be quite high compared to a home equity line of credit. So if somebody has enough equity in their home that they can qualify for a home equity line of credit, and they need a little money, maybe to help their kids or something like that, then that's a better deal. The reverse mortgage, I see that they're being advertised heavily on the financial news networks, and they usually use an older actor, somebody who was really famous about 30 years ago, like Tom Selleck, for example, is the person doing the advertising. So you can see they're targeted at, first of all, people who know who Tom Selleck is, and that they would have to be older. So, but I think they are expensive. The costs are prohibitive. There is one company in Canada that specializes in those loans, and I don't know how popular they're going to become, but certainly if people can't afford their retirement and they have to do something, the other option would be to sell your home, invest the money, especially if interest rates rise to the point where you can actually get a good return on a GIC or something, and then rent rather than own the home.
Right, use the income from the sale of your home. Yeah,
exactly, and the income. Then you have the investment, and then, but most people won't do that because they like the control that being a homeowner gives them. But for some people, if they have too much house and the expenses are really high, and they're struggling with being able to afford to live on a minimum pension payments, selling the home and renting would be an option to consider. I'm in my 39th year of doing this investment advisor thing, and in the last 2 months I've had 3 conversations. This is the first time this has ever happened. I had 3 conversations with older people who basically are starting to run out of money, and I don't remember that happening ever before. And to have 3 in such a short period of time is quite amazing. And so 2 out of the 3, there was, all 3, for example, one common denominator is multiple real estate properties are owned in the families, And in 2 out of the 3 cases, it involved people helping their kids to buy real estate and other and not just real estate, but in one case, helping kids with, they'd lost their job or something like that. Now this might be an Alberta thing. I don't know how common it is in the other provinces, but in Alberta, because of the job losses, there's starting to be some situations where somebody has, adult children, maybe 35, 40 years old, and they've lost their job, and there's grandchildren, so mom and dad swoop in and help. But it's starting to get to the point where they're putting their own financial health in jeopardy. So to have 3 conversations like that in the last 2 months is kind of it's very. I can tell you for sure it's very unusual. In 39 years, I've never had that before, and it's a little bit disturbing because one of the things that would have been nice if we could have wound the clock back is to say, well, don't help them buy real estate because there's no real need to buy real estate. Save the money and maybe you can help them with living expenses if they get laid off from their job.
But that's a hard thing. Canadians, I think Chinese and Canadians in general love buying real estate, and it makes us feel secure.
It's right, and it's widespread, and it's deeply held belief. I've learned that in the last year and a half since the book came out, that it's a very, very widespread belief, and it's also very deeply held. It's not something that, you can sort of, in a 10-minute conversation, dissuade people from believing. So, but unfortunately, the underlying assumption in all of this is that real estate prices would always go up and never go down. So if we actually are going into a situation where real estate prices are going down, there's going to be a very large amount of grief in many families because what do you do? Do you help them hang on to their real estate, or do you let them, let the real estate get foreclosed on and help them with their living expenses? Sometimes, trying to hang on to the home where the mortgage payments are too big and somebody's lost their job, it would be better to let that go and just help them with their living expenses because they're still going to have to live. Like, they're going to have to. I wouldn't even be surprised to see families where people move in together. I actually last week I met a potential new client, and she was saying that her parents have been living with them for many years now. I said, "What's that like?" Well, sometimes it's kind of tough because Grandma likes to, with her kids. Grandma has different opinions about how to raise them than I do. There was a few battles that happened, but anyway, they got through it somehow, and of course, it saves tons of money. Like it's just unbelievable how much money it saves in terms of maintaining multiple households versus just having one household. And built-in babysitting, although you may not agree with the parenting attitudes of the built-in babysitter, but it's certainly one option if people are really up against it. Consolidating households would be a great way to go, but that's not going to help the real estate market, that's for sure.
Well, in Vancouver, the Indo-Canadian community has always done that. Everybody under one roof. Yeah,
and if you say, well, how do people save so much money? Well, that's one of the ways they do it. Everybody's working, and not to stereotype, but obviously, I think most people are able to go out and get a job, and when you're only paying rent or you're only paying a mortgage on one property versus one of the things that happened. This is new in this last 20 years is where everybody has their own place, even if they're single. Single people don't really need a house. You could even say married couples don't need a house. Even married couples with a young baby don't need a house. They could still raise a baby in an apartment, at least for a couple of years, till the kids get a little older. So this idea that everybody needs their own space, I think I may have mentioned before in our chats that Canada, the U.S., and Australia have the largest amount of space per person by a huge factor. We're in the 70-something square meters per person. Germany's like 35 square meters per person. And, people in Germany are not poor. They're just as wealthy as we are, maybe even wealthier in a lot of cases. But they just don't feel like they need all this extra space. And so maybe the people that have multiple generations living in one home are onto something there. It certainly would make sense to save money anyway, if nothing else.
Yeah, well, a lot of the scenarios you've talked about just in the last 5 minutes, that's happened to my family. People moving in, people losing jobs, people consolidating property, all those things.
Yeah, I mean, I think what happens is people do whatever they have to do, right? It's like, and the thing about, I probably could get accused of pushing renting too hard, but really one of the things about renting that's quite interesting is there's no real cost of changing household. I mean, you just give your notice, and if you clean the place, you probably even get your damage deposit back, which is very cheap. There's really no cost other than maybe hiring a moving van or something. Compared to selling and buying another property, there was a statistic out this week somebody put together on a graph, which is just a shocking thing. But the cost of the percentage of Canada's GDP, the cost of buying and selling and transferring the title to property, so that it's the real estate commissions, the lawyers, and the registering the title and all that kind of stuff. I forget the exact percentage, but I think it was up as high as 3% of GDP. So the total research and development into new scientific ventures and new advancements in productivity and all that is quite a bit lower than just the cost of everybody buying and selling properties every year. So we're going in exactly the wrong direction in terms of where we're putting our money, and we need to concentrate more on keeping our competitiveness as an economy with the rest of the world, and putting all of our money into buying houses, then paying mortgages and interest, and then selling them, and then buying another one. Most of that is very non-productive spending.
Hilliard, thank you so much for all your help over the year, and have a great Christmas.
The same to you, Jim. Have a great holiday season.
My guest has been Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. On YouTube, we're Talk Digital Network. Questions for the show can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.